For sure, we are all familiar with investment banking names like Goldman Sachs, JP Morgan, Morgan Stanley, and similar. These banks are such powerful players, yet the broader population usually don't understand what they do and how they operate. So, let's explain. When we say a bank, many people think of collecting deposits and approving loans, yet that's what commercial banks do. Investment banks deal with stocks, bonds, and other securities at capital markets. At their core, investment banks act as a middleman in providing financing or orchestrating the process during complex M&A deals. Yet some of them are very active in securities trading and asset management services as well. So let's dig deeper into each investment bank business arm. Financing activities, or underwriting debt and equity. Here, investment banks act as intermediaries between governments, municipalities, or companies seeking to raise capital and different investors willing to provide it. For example, they orchestrate the process of issuing bonds or T-bills. Or at the capital markets, they help different companies to list themselves at stock exchanges via IPO process or by raising additional money via recapitalizations and private placements, and similar. For example, when some company reaches a certain volume and stage of development, an IPO is a logical next step to be listed at stock exchange and being available for investments to a wide population and institutional investors like mutual funds, pension funds, insurance companies, and similar. After all, that's how many venture capital and private equity funds make their exits, or prospective companies raise the money for further development. So let's say Company X needs additional 100 million euros to expand the business overseas. It's going to approach an investment bank to organize an IPO process and list the company at the stock exchange. In this case, an investment bank will act as an underwriter, meaning it will check the company creditworthiness, take care for the entire process, assess total market demand, the right moment for the IPO, set the number and type of shares to be issued, set the pricing, register the stocks and get approvals. It will animate relevant market players willing to buy, and similar. After all, that's how stocks are created, meaning how new companies are listed at stock exchanges for the first time. Basically, an investment bank organizes the process of issuing and selling the stocks, and takes a risk to provide a seller with funds promised by keeping for itself all the unsold stocks and earning a fee as a percentage of sold value. That's why they are underwriters, with skin in the game. It's a similar process when issuing bonds for different companies or governments. In addition, investment banks provide a variety of other financing solutions to meet the unique needs of their clients. Private placements. For companies not ready or willing to go public, investment banks can arrange private placements, where securities are sold directly to a small group of investors like private equity or venture capital funds, family offices, and similar. This process is faster and less costly than a public offering. Syndicated loans. In cases where the funding needs are too large for a single lender, investment banks arrange syndicated loans. They coordinate a group of lenders, spreading the risk and securing the necessary capital. Mezzanine financing. When a company requires additional funding beyond what traditional debt or equity can provide, investment banks may offer mezzanine financing, which blends elements of debt and equity. This option is often used in leveraged buyouts or growth capital situations. M&A activities. Here, investment banks act as advisors to companies during the M&A deals. Yet, there is more to it. It's only one aspect of being a linchpin between a prospective buyer and seller. Another dimension is related to assessing company value, setting a deal timing, animating and finding prospective buyers or sellers, crafting strategies, and deal structuring for the purpose of successful deal execution. For example, in deals worth a few billion euros, it's hard to expect companies to have such huge amounts of money parked at the bank account, waiting for a possible deal to happen. investment banks are uniquely positioned to help the clients by combining their M&A advisory services with financing activities. They might secure bridge financing for the buyer at a critical deal phase, so the buyer can finance the acquisition smoothly. During the next phase, investment banks will help the client to change unfavorable capital structure of the client by replacing the temporary, meaning expensive bridge financing with more affordable, permanent sources. For example, by helping him to issue bonds, as explained previously within the financing activities. Keep in mind that investment banks play an important role in other aspects of M&A deals as well, like initiating and facilitating negotiations and deal terms, helping with due diligence process and risk mitigation, regulatory approvals, post-merger integration, and similar. Trading activities. Here, many people think about scenes from movies related to simple brokerage services, a guy selling by phone stocks to a wide population. Yet, when we speak about investment banks, there is much more to that. Actually, investment banks are focused on large players, where hedge funds, pension funds, insurance companies, and mutual funds are the key players. Since some of those players are driven by active management strategies, investment banks serve their needs to buy and sell huge lots, or packages, of different securities. Or when we speak about hedge funds, investment banks help them in their unique hedging strategies, for example, by designing and selling different derivatives, like options or futures, for example. In addition, investment banks play a huge role in market-making efforts when they issue new securities. Part of their job is not just a listing itself, but a security to keep trading on the secondary market. On top of trading at stock exchanges, keep in mind that investment banks are very active in debt and money markets as well, meaning with bonds and T-bills, plus with trading with currencies and commodities. On top of that, investment banks are involved in proprietary trading, meaning investing their own money at capital markets, and acting just like any other hedge or private equity fund. Asset management activities. Here, investment banks are among the key players as asset managers. Many large investment banks have their own divisions responsible for launching and managing all sorts of funds, private equity, hedge funds, or mutual funds. They pool capital from various investors and manage their money for a fee. That's based on their unique expertise and market positioning, plus a strong relationship with many ultra-high net worth individuals and family offices. Simply said, an investment bank offers equity, fixed income, alternative investments, and money market investment products and services to individual and institutional clients. For alternative investment products, an investment bank co-invests with clients in hedge, private equity, and real estate funds. Finally, keep in mind that only the largest investment banks, usually those with a global presence, are involved in all the mentioned services, while smaller players gravitate towards financing or M&A advisory services. The smaller the bank, the more specialized it is, usually towards boutique advisory services, since those require the least capital. To conclude, yes, investment banks are very powerful and important players for the economy as a whole. They help in providing funding for prospective companies and governments. They create various investment instruments for all sorts of investors, increase market efficiency via M&A deals, and by concentrating and allocating capital where it's needed the most, and similar. So next time you see a huge deal happening, check who's behind it.